Howdy, Jacob here. Today we're looking at the Kraft Heinz company. So we're looking at a company that most know for their infamous mac and cheese, Kraft mac and cheese. The Kraft Heinz company was founded in 1869, so we can see it's a bit aged of a company. Roughly $45 billion market cap, roughly $63 billion enterprise value. So a good amount of net debt there. We're talking about 18 billion, but let's see what they make in cash flow after a look at the dividend yield. So 4.4% on the dividend yield side, which hits our screener. So let's see. So long-term debt was about 10 billion 10 years ago. Got all the way up to almost 30 billion and is back down to about 20 billion. Let's see what that is as a percent of 5-year average cash flow. So if we look at 2022, we're looking at about 1.5 billion. 2021, 4.4 billion. 2020, 4.4 billion. So let's say 5-year average about 3 billion. That is still over 6 times their 5-year average, which is more than you'd prefer. But a company like Kraft might be fine with um, that. It looks like due to them having little growth potential, they use a lot of their cash for dividends, and then looks like more recently they've been really good at paying down debt. So nothing wrong with that. That's solid use of cash for a company that doesn't have a whole lot of growth ahead of them. And again, like I said, 3 billion payout, roughly 5-year average, and their dividend consumes about 1.9 billion, almost $2 billion. So roughly 60% payout. I think we can start getting to some assumptions here. I mean, the company itself, you may love the mac and cheese, but if you look at growth prospects and everything, I don't think anyone's saying or anyone's going to deny it's not the sexiest company from a growth standpoint. So for me, I would say maybe just 2% on the revenue growth, assuming that it's roughly in line with inflation, maybe even decrease a little bit, but then they get to increase their prices. And then share change zero because they have been very consistent of a little bit of stock-based compensation, but just not buying back anything. So just going to assume zero there. Um, I mean, Kraft's interesting, right? Because like in the mac and cheese realm, I feel like they have a mode. I feel like the like hot Cheetos things, mac and cheese coming out just aren't really competitive with it. But also the numbers should be showing that it's a lot more competitive by having a higher return on invested capital, meaning that they could increase their prices relative to the earnings that they get, and people would still go out and buy Kraft Heinz. So I think the numbers don't really show it. So I don't. I think I'm just going to put a 13 on the price to earnings and price to free cash flow, saying, maybe they'll have some growth. Well, in 7 years, I presume they'll still have growth with inflation and everything. I don't think people are just going to start hating on Kraft mac and cheese, but really, you never know. But I think 13 should be fairly conservative. And as for margins, earnings margin has been all over the place, average about 10. Let's maybe say like 6. Well, let's do 7 and 9 because they do have a little bit debt, so I bumped their margins down a percent based on their 5-year average, just in case interest rates going up on their debt affect them. Which, if we look at long-term debt, about 20 billion, increase about 2% should be 400 million. That would increase. That would affect their free cash flow and earnings by probably 20%, almost 15 to 20%. So maybe I'll even bump this down to 6.5, 8.5, and then I'm fine with this dividend. I think $1.60, 2/3 payout is reasonable. So I think I'm just going to keep it at the current rate. And when doing that, it tells us that given these assumptions, the stock's going to have to fall 58% before we get a 15% return on our money. Again, given these assumptions, I think Kraft Heinz is such a well-known company. I think the dividend should be fine. I'm not really too worried about a 2/3 payout if there's no other potential for growth and the use of cash flow just doesn't really make sense to them. But I do think this is a company that's going to grow pretty much in line with inflation. I think, maybe there's a chance the core business falls a little bit, but then through acquisitions and inflated costs, revenue should be growing essentially with inflation. So for now though, it's not at a price that's attractive enough to where I'd want to go out and it's a screaming deal. So I'm just waiting. Thank you and have a good rest of your day.